Great. So the agenda of the meeting is that I will basically be spending 3 or 4 slides, and I've picked up a very interesting topic. This topic is close to everyone's heart, I'm pretty sure. This is close to my heart for sure. This is something I've learned the hard way. And so once I'm done with the presentation, we'll open the floor for the Q&A. Let's make it a little interactive. The cash call dilemma. Now, there are two kind of cash calls, guys, and एक तो होती है the one where your system has basically been able to pull you out of a problem, of a forthcoming crash, and you saved. दूसरी होती है a cash call which is forced upon you. Market crash, you panic, हमारी फट गई, and we have decided to square off the position. We've all been through that. At least I've been through that. The second kind of cash call, and that's the worst kind of cash call, because invariably you end up squaring off the position on the last tick. एकदम bottom ही pick होता है उस पे. Your panic is the bottom. उसके बाद से market reverse कर जाती है. But just to make it interactive, tell me. You can unmute yourself and tell me. Do you guys take cash call in your portfolios? Both varieties, the systematic ones and the panic ones.
I do a lot.
Which one?
Systematic.
Guys,
So
unmute
cash
yourself
call-
and tell me.
Cash call means like the SIP and the stock you buy? What?
Yeah, basically saying that ke ye, your call based on macro or whatever, that war hone wali hai ya ye hone wala hai, XYZ reason, now I'm moving into debt and I'm not going to be prolonging the equity exposure.
No, actually, I do not go for cash calls. Like if I say about my thing, then I just see that, I try to understand which company is better. Like I cannot understand, like I cannot read really about the company as a whole, but somehow like little bit of fundamentals, little bit of, their financial, based on that, I just take a call and then I try to invest in there.
Okay. So
And
essentially,
SIP, I do some SIP, so I just take like mix of everything, like small, mid, and large, or some flexi, and that's how I do my SIPs.
and so you let it run regardless of ups and downs of the market.
Yes, regardless of ups and downs. But yes, of
Fascinating.
course, in case of equities, when like now I have majority of small and mid caps in my portfolio, and currently that there is no, I mean these two segments are going down. So like in some cases I have drawdown of like 20-24%. Somewhere I have like 5-7%, but overall yes, it's struggling.
Got it. So the people, when I speak with them, the people who have direct equity exposure. Sorry.
Manish here. So
Yeah.
maybe I can crowdsource my decision now here, because I think I have a good company. You're talking about cash call. I'm actually in the middle of thinking through that. So about a year and a half, I invested in let's say a PMS. Okay. The systematic PMS or the momentum PMS. Okay. Now the screw up that I'm experiencing is that I thought that even though the entire thing is down, these guys will be like the least down, right? It's like the best of the worst, right?
Right.
But it so happens that these people are worst of the worst. So now let's assume I have a 5-year horizon and I need to, let's say, expect a modest ROI of, let's say, 12% XIRR, right? IRR.
Right.
Already 1.5 years have gone by. I still have 3.5 years. If they need to meet my, let's say, 12% IRR, the probability is looking very bleak, right? They have to probably bring in about like 25 to 27% IRR for the next 3.5 years.
Yeah, interesting, Dinesh. I covered this exact point in my next slide, on the next slide.
Okay, there you go.
Yeah, this is true. You're absolutely correct. The dilemma of cash call is that not only you would not be reducing the drawdown, the point is you'll also ding the alpha. So it's fascinating, yeah. Right. So the cash call dilemma, to do or not to do. It's $1 million question, and I'll basically act like a devil's advocate, try to tell you कि दोनों side आगे कुआं है पीछे खाई है. So it's not a very easy decision. I tell you why not taking a cash call is pretty stupid. The cash call dilemma is, अभी latest example देखते हैं, Corona crash जो हुआ था 2020 में. So Corona basically saw the indices fall 34%, and I'm talking about Nifty. जो top की 50 companies हैं, वो 34% गिर गई थी, 34% drawdown. Now usually V-shaped recoveries don't happen every time. ये तो अभी सीधे का सीधा जैसे ही गिरा, less than 1 month we stayed there and just bounced back. In fact, by May we were up and running back into the new highs, and a very ferocious rally started. इसलिए वो दर्द किसी को महसूस भी नहीं हुआ. Just imagine if a Corona crash had happened at 34% and we had stayed there for another 6-7 months. That would have resulted in a cash call, panic selling for majority of us. Second important point in the Corona crash thing, 34% is Nifty. None of us is invested in Nifty. We're invested in the mid and the small cap world, where the pain would have been easily double, if not more. So just to bring home the point, your favorite, okay, what's the best performing PMS these days? Unmute and tell me. And I'm sure this name would pop up, and I'll tell you a fascinating conversation I was having with Anish the other day.
Equitas.
Yeah, Siddharth Bhaiya, right?
Yes, yes.
So he is talk of the town, and an amazing CAGR that he has achieved, and the cash call that he has taken last year worked out well as well. But I was speaking with my friend, and he said a pretty interesting thing. The credit needs to go to the clients and not so much the PMS manager. You know why? No, none of you are aware what kind of drawdown he went through or the clients went through. They were down more than 70%. Let that sink in, or maybe it was 60%. 60% drawdown. In my 15-year journey, I have not come across a single client so far who's okay with a 60% drawdown and they'll still stay put. So the credit has to go to the client for this. This 34% Corona crash is applicable only to the Nifty. The real world in 2018-19 basically went down the dumps. 60-70% drawdowns is not a big deal. And अभी तो मैं 2008 की बात भी नहीं कर रहा, जहाँ पे your momentum index itself went down 75%. So cash call होना, I'm acting as a devil's advocate. Cash call होना बहुत जरूरी है, because 75% drawdown अगर जब भी आया, AI bubble burst होगा या जब भी होगा, it can decimate portfolios. And I don't know anyone who will be stoic enough to say that I'm okay with a 75% drawdown. Just do a mental mathematics in your mind. Whatever your net worth is, उसमें से 75% हटा दो. That can give you sleepless nights. So, being a devil's advocate, इस साइड की बात ये कि cash call लेना मेरे हिसाब से तो it's not even an option. You have to take it. Nobody can handle this kind of a drawdown. Now the other side. Is it a no-brainer? अगर इतना ही आसान है cash call लेना, तो हर कोई क्यों नहीं लेता? हर कोई इसलिए नहीं लेता because you basically look like a donkey 3 out of 4 times. हर 4 cash call जो आप लोगे उसमें से 3 bogus होंगी. We have seen that in our advisory product MWM as well. Crash से वो बचाता है. Like we were safe from the crash when we were running it in small case. The Corona crash had our drawdown was just 9%. बट प्रॉब्लम ये है कि वो एक क्रैश से बचाने के चक्कर में 3 बोगस कैश कॉल्स देगा which will ding your alpha. And this is to your point, Dinesh, what you're mentioning. In a bull run, those cash calls would turn out to be a stupid decision क्योंकि वो buying the dip opportunities थी. Second important point with the cash call is a decision fatigue. And it's a not much talked about topic because every time you're taking a cash call and going back in, you're putting lot of psychological pressure in your life. See, not everybody is a full-time investor or a trader. You're doing your job as well. You're busy with your family. You're busy with your work. वापस आके आप अचानक से कैश कॉल ले रहे हो, फिर वापस बाय आ रहा है, फिर बाय कर रहे हो. The decision fatigue is so much that again 7 out of 10 people will not be able to pull it off. And the problem with decision fatigue is that अगर वो fatigue उस समय आ गया जहां से नया bull run start हो रहा है, you will miss the entire rally again. Third problem with cash call is the problem of FOMO. और ये बहुत बड़ी चीज है. Like credit where it's due. Siddharth Bhaiya took that cash call in last year. Cash call लेने के बाद market ऊपर गई थी. ऐसा नहीं है कि his cash call was perfect, and he was still okay with it. That FOMO can really screw up when you are sitting in cash. While you are sitting in cash, the market's going up, your neighbor is getting richer. Not many people can handle that. So this is my devil's advocate point on both sides. एक तरफ मैं आपको बोल रहा हूँ कि cash call लेना जरूरी है because nobody can handle this kind of drawdown. दूसरी तरफ मैं बोल रहा हूँ it is not a no-brainer. There are a lot of drawbacks of taking a cash call, and you need to be a next level stoic to pull it off. So what is the solution? This is the concept of a Rory clock. This Rory Sutherland is the guy, advertising guy. He was giving this presentation, although Rory clock is applicable in other decisions of your life as well, but this is so applicable in the cash call mechanism, so I thought of using that as an analogy. So what is a Rory clock? So if you see this dial, the inside dial, the one in black, is basically your miles per hour. ये आपकी speed बता रहा है. And जो outside dial है, the blue numerics, they are basically the time. They're telling you how much minutes are you saving with the increase in that speed. So if you notice, let's just say if you are at guys, can you mute yourself? So let's just say you are driving your car at 10 miles per hour. It will take you around 60 minutes to reach your destination. Now, that's not optimal, and that's pretty pathetic. You're too slow, and you're in fact blocking the traffic and receiving abuses from behind as well. People are honking at you. Let's say you increase your speed now and move it to 50. Now it will take just 12 minutes for you to reach your journey. And so you have really seen the benefit of increasing the speed. Increasing the speed is definitely beneficial because you have saved up so much time. कहाँ 60 मिनट लगने थे, अब सिर्फ 12 मिनट में आप अपनी destination पे पहुंच जाओगे. But this is where the incremental benefits start reducing. Now, increase of speed is not really adding up much. Just to give you an example, let's just say if you're at 80 kilometers per hour, and from there on you go crazy and go to 120 kilometers per hour. Now you're basically risking your life and taking risks which are beyond your control, and you're one mistake away from actual fatal injury. And yet, for what? You just saved 2 minutes. वरना 7 मिनट में पहुंचना था, अब 5 मिनट में पहुंच जाओगे. For saving 2 minutes, you're taking some crazy risk. The analogy, how it fits in with the cash call mechanism is that while cash call is important, you need to take those cash calls because the drawdowns can be crazy and screw up your entire corpus. Taking too many cash calls is counterintuitive and would actually be bad, and all the drawbacks would come. The FOMO would come, the decision fatigue would come, and alpha will get dinged. So there is this sweet spot. You want to take the cash call, but not take them so much that incremental benefit is pathetic. So what's the solution? The solution, at least as far as my knowledge and my understanding over the years is concerned, is always asset allocation. You need to basically dilute down your portfolio with an uncorrelated asset class and bring it down to your sleeping limit. Like when we were running momentum, we did this with momentum and gold 70-30 drawdown without affecting the alpha too much. Now in the mutual fund solutions, what we have come up with is a concept called debt as a dry powder. What does that mean? 30% is allocated to the liquid debt. This debt gets redeployed at preset drawdown points, and it becomes equity again. So when we were running an advisory, we realized that at preset drawdown points, our momentum and value products were bouncing back. Let's say around 20-25% drawdown points. This is a great time to basically time the drawdown, if you may, and get redeployed into equity. And then once we are closer to the highs, go back to the same asset allocation of 70-30, where 30% is again allocated to debt. Now, this has triple benefits. First of all, it removes the FOMO. It's not that you've taken the entire cash call and you're sitting in cash while others are getting rich. At all given points of time, 70% of your portfolio is actually exposed to factors like momentum and quality. It removes decision fatigue. Bar bar in, bar bar out, karne ka jhanjhat hi khatam. You're always in the market. And it removes crazy drawdown. Jo, if a crash were to happen, that 30% liquid debt will come in very handy and reducing that debt component. So according to me, that's a win-win-win solution. With that, it's a wrap, guys. This was a quick presentation that I wanted to share, and now we're open to the question and answer session.
I'll just add a couple of points. Let me share my screen as well. So, if I don't know how many of you got the chance to read our newsletter, we sent it out yesterday, last night actually. So we are talking about something completely opposite there. That don't be scared of the drawdowns. Now, who makes the most money in stocks? It's the guy who can actually stomach these drawdowns. Okay. Now, the question that we need to ask is, what is our threshold? If I am the kind of person who's okay to get 80% kind of drawdowns, there is a high chance that I'll do the best in the market, but not everyone can do that. So if you do an analysis, past 10 years, the stock that has given the maximum return in terms of CAGR, it's something called Lloyd's Metals. I've just opened the chart here. I'll just show you what was the journey like. But to get that
Which one is it?
Lloyd's Metals.
Lloyd's.
Now, it's a 80% CAGR over the past 10 years. Okay, 80%. You can make the calculation of how much the return will be in absolute numbers. But look at what one has to go through to get that 80%. So this is 2011. This is a weekly chart, by the way. From here to here, it is down 88%. Okay. Then again, 82% drawdown. Starts moving, starts moving, starts moving. This drawdown is 30% almost. This is 21, by the way, after Corona. This is 22, 45% drawdown. Starts moving, starts moving, starts moving, going up, again a 36% drawdown. And that is the final top. If you look at the chart zoomed out, it seems like, oh, this is a multi-bagger. But to get that multi-bagger, you have to have either too much faith in that company, in the business, or too much faith in yourself, your abilities, or just divine intervention. It is not humanly possible to go through all these kind of drawdowns and say, okay, I am fine, I am just going to stay invested. But if you can somehow, you will make a lot of money. There's a high chance that you will. But there are two sides to the coin always. Who knew that after this 80% drawdown, the company will do well and go back up? Okay. So why I'm pointing this out is we need to be aware that both things happen. So we have to find out a way that works for us first. A lot of people can probably get this 80% CAGR, but what we are not trying to play that game. Great. So we'll open up to Q&A. if any of you have any questions related to anything, we are fine. Just you can unmute yourself and ask.
Yeah, Varanya, may I?
Yeah, of course.
Okay, so if we look at the mutual fund offering by Inflow, we are investing, the core equity investment goes into only two factor schemes, right? One is quality, other is momentum. We are
Yes.
not making investment into any other uh, equity scheme.
Yes.
Is that correct? So we are not taking a bet on active fund management at all.
Yes.
That is correct, Yogesh. So our backtest suggests that in India, if you have exposure of momentum and quality factors, the combination covers pretty much all the alpha there is. To answer your question, we do have sector calls from time to time, which would augment this portfolio, and so that those sector algorithm will pick up. Any movement that might happen in small caps, mid caps, or even country, China, Taiwan, or commodities, gold and silver. So when you combine this as a singular equity curve product, this will have very smooth equity curve and will capture alpha wherever it is.
Yogesh, sorry, I didn't understand your question fully. What was your point? We are taking only two funds, not doing any active.
No, so we are not taking any bets on the active fund management schemes, right? We are just looking at index factor products. And
Yes.
so do we have any kind of chart or something which gives us this combination of quality and momentum? What are the kind of returns they have generated over, let's say, last 5 and 10 years?
Yes. Okay.
Do
Just
we have
give,
any? Yeah.
so I'll show you.
So while Varanya is taking that data out, I did create a video presentation around that. I will be happy to send it to all the participants in their email. This video basically talks about the equity curves and what kind of returns can you expect. Although expectation is something is a dicey subject, so but just to put things in perspective, yeah.
Okay. So Yogesh, let me start from the beginning. What is the ideology and why? How did we come to this factor portfolio? Any person who's investing in stocks through mutual funds, they will never have only one fund. You will rarely find someone who has invested in one flexi cap and that is it, and they're living peacefully. Okay. Uh, More often than not, people will go for 5, 6, 7 different 10 odd funds. Now, what happens is once you go past 2 or 3, you are anyway owning the index. We have done this analysis for a lot of clients now. On average, people end up owning a portfolio of 300 to 400 stocks. If I show you some of them, it'll be a no-brainer for someone to understand that you are anyway owning the index. The same HDFC banks, the same ICICI banks, the same Reliance Industries is repeated through all the schemes. Not to blame the people who are managing these funds, but that's a mathematical reality. Once you grow too big, there are only so many companies that you can buy in India. Okay, so so let's work with this assumption that people will anyway be indexing if they are doing more than 2, 3 different funds, which most of the people are. Now, if we are going to get returns that are similar to the index, why not just buy the index? Okay, because it's a lower cost product. One. Second is there is no risk that we run that the fund manager will do something stupid tomorrow. Third is that why do we take the pain of thinking about what is to be done on my portfolio? If you are just indexing, you can just sleep and say, okay, whatever the index will do, I will get that return. Now, as Manish mentioned, if we combine two different types of indexes, when I say two different types, two different strategies, momentum, and here we have chosen quality, the combination works a tad bit better than normal indexing. As you can see in this chart, this is a portfolio where we are doing 35% in momentum, 35% in quality, and continuously holding 30% debt. The blue line is showing the returns for the factor portfolio. The orange line is one of our clients' portfolio. I won't reveal the exact portfolio, but you can see the difference. This is just like a normal diversified mutual fund portfolio, which has more than 10 different schemes in it. Now,
so just to put things in perspective, this yellow line would be functional equivalent to buying the entire market, because that is your typical good retail investor is 10-12 म्यूचुअल फंड खरीदे होंगे, पूरा निफ्टी 500 ही खरीद रखा है. So
yes.
that's what it is.
Now this is by using only 3 funds, by the way, the blue line, and completely holding 30% debt all through. Unfortunately, we have data only starting from somewhere in 2014, 15 mid. But if you do this analysis, I'm pretty sure it will be the same. Maybe the chart will not be showing as much gap as it is showing here, but the returns will be similar. The key point is the drawdowns will be lower. That is where we are trying to hit the point that if we can do the same thing in a better way, same 15% return in a better way, why not do that? Last point, this 30% is just to do a back test. What if, like Manish said in the beginning in his presentation, when the market crashes, we can use that as a dry powder and increase our equity exposure. So say something like into 2020, when the market was down, what if at some point of time we figured out that, okay, Corona is going to go and let's, increase our equity exposure. If we are able to do that, then this blue line will be even higher. So that is what me and Manish, we feel we have some kind of skill in doing that, but only time can tell whether we'll be able to achieve it or not. Yeah.
So, so do we have actual Nifty 50 and Nifty 500 curves with this factor debt 30? That comparison is there?
We don't have it ready right now, but we have made that test. It's far better than Nifty 50 and Nifty 500 on both the
I've
sides.
created the videos, Varanya. I will be happy to share with you all.
Yeah.
Okay. And so
Hi, sir.
this would be.
Yeah. Sorry. My question is like, do you have CAGR here? Like how much the yellow line and how much the blue line has given since 2014?
So this is a client portfolio, so I will not be able to share the exact CAGR, but it is around 14 point something % for the blue line. For the yellow line, it's somewhere around late 13%.
Okay.
Yes.
So 14% CAGR, and what was the maximum drawdown that we faced with the
30%?
Sorry, how much?
Around 30. So this one,
30.
The one that you see
Okay.
here, this one probably was the biggest one till date. But
very surprising, that this is a higher drawdown than actually Corona.
Yeah. So see, we don't claim that we'll never have drawdowns. We are just claiming that we will not fall as much as the normal index, because for the past 1 year, momentum has stopped working completely. So you can have bad drawdowns there, but we are not claiming that we will always do better than the market. It's just that over a long period of time, it will do better.
So I think on the next call, we should have this factor debt 30 comparison with Nifty 50, 500 and the pure momentum strategies which Nifty is offering. So we sort of kind of come to know about the superiority of this strategy versus,
As Manish mentioned, I think he has done some of it in the video.
I will share it with you all. And to answer your question, so Yogesh, pure vanilla momentum would obviously be generating more returns. वो आपको 18% return दिखाएगा. But that is in the past. Like quality has not worked in the past and momentum has. But this will not be the future. The future would be anybody's call. But the difference, the kicker would be the drawdowns. So I'll share that with you. वो 18% CAGR लेने के लिए मोमेंटम में आपको 70% के drawdown से गुजरना पड़ता है.
See, and just to take a step back, think of it in this sense. This is a product which is always keeping 30% debt. Like this chart is with the assumption that we never change that debt component. It is always 30% all through, which will not be the case in what we are doing. So we hope that we do better than this chart as well. But yeah, I mean, only time will tell that. What I'm trying to tell here is, in spite of keeping that, the result seems to be a bit better. And remember one more thing, this is not a product to generate alpha and get the best returns out of the market. This is for mutual fund investing, where people anyway will get market linked returns and market linked drawdowns. We are trying to one up on that.
Basically, this becomes your core portfolio where you're doing SIP blindfolded, being assured के market जैसी return मिलेगी या उससे थोड़ी better मिलेगी और drawdown कम रहेगा. And as far as alpha is concerned, we will have kickers in the sectoral bets that we'll take, which will smoothen the equity curve even further and increase the alpha. The combo of sector and this factor creates the smoother equity curve. The point is, इस वाले portfolio में सोचने का नहीं, because we have figured it out now. इस पे बस SIP करते चले जाओ. I mean, at least that's what I am doing.
So, and as per our this cash call model that we have set, cash calls would have been triggered after 2024, given the extent of fall we have seen.
That is correct.
No, so not exactly in March 2020, but probably.
He's talking about the latest.
2024. So maybe Varenya, what we can probably on the next call we can see that if the cash call deployment mechanism or the algo that we have developed, if that was used, then what would have been the picture?
So that
simulated one.
Which that will be unfortunately very difficult to do, because again, hindsight में सब कुछ 2020 दिखेगा, right? मतलब perfect vision and
so this is just to get an idea. Let's say from 2024 onwards we are seeing this crash. If whether this, what would this model have done from after 2024?
Sure, we try to do that.
Yeah. I'll just answer you. This model would have taken converted the debt into equity.
No, obviously he's saying that whenever whatever our criteria is, if we run that on the past data, how would it perform?
Yeah, more like back testing or simulations.
Yeah, I'll do that. It's just that it's just that the reason why we are not showcasing that out front is because I don't think this falls in the SEBI's ambit of a mutual fund distributor. So there are restraints around that. But yeah.
Yes, and also Yogesh, to add one more point. See, we can do that, but then that will be like raising the expectations of all the clients. We don't want to do that. Okay. If the cash call works, it will work for everyone simultaneously. If it doesn't work, it will not work for everyone simultaneously. But if I do a back test and the back test shows that I'm able to generate an alpha of say 4-5%, this chart will look very, very different. I don't want to raise those expectations actually. But your point is taken. We'll try to do that. If it is a reasonable outcome that we can explain, we probably add to the call. Maniji, I think you had a question.
I was having that question about CAGR. So just one more point, like normal people do SIP based on some research. Like suppose if I have to do SIP in a small case or a small sector, then I will just see some SIPs like, how they are performing over the 5 years. Yes. So if I see like, okay, some are giving you CAGR of 32%, some are giving CAGR of say 20-25%, then maybe I will choose the best one, which are giving the highest CAGR.
Yes.
Because those SIP has already gone through the Corona scenario and all other, crashes which had happened.
Yes.
So now people do know that, okay, this SIP is perfect to choose from the small cap. Similarly, they choose another one or two, like, in a different caps. Yes. So this is how they do.
Yes.
So now, like, if they have to combine it with the index fund or just one or two cases, maybe they will feel that yeah, like why just like maybe choosing 2 3 small cap companies, or maybe choosing 2 3 large cap and mid cap, maybe balance their portfolio, and it may save from the crashes as such. Sometimes small cap is not doing good, sometimes something is not doing good, so this will keep like balancing their portfolio.
Yes. So Manish,
So
yeah, sorry, please continue.
yeah, so how's your call, like then how to like come out from that mindset and do something new as you are proposing, like
So
and where I'm feeling that okay, suppose current my portfolio is giving me CAGR of 20 plus, and where we have seen major crashes already.
yes,
So how I will convince myself that okay, still this is not good. Maybe yeah, crashes may happen, like you said, that maybe sometime drawdown may become 60-70% in worst case, like in 2008. I don't know what was the crash drawdown in like in 2008 scenario. So
okay.
sometime may happen after crashes like what we have seen today, but maybe still like somebody is having put a CAGR of 32%, maybe they're still able to sustain quite well at that situation.
Yes, yes.
I'll answer this question, Varanya, before you do. Manish ji, what I think is that this is a clear case of recency bias. So if you actually draw the small cap index ka returns, you will realize that this 30% CAGR is just the last 5 year ka game, where everything has just gone crazy. Uh, small cap index mein, if you do a SIP or a lump sum, the returns are pathetic because it's a mean reverting index and it gives away everything it has earned in the bull run. The next ensuing bear market basically वो सब वापस कर देता है. So
Yeah.
even to presume 30% तो दूर की बात है, 25% भी if you are presuming that small cap will give is like asking for too much. And it's not your fault. This is the way the bull run has been. The precedent has been set incorrectly. The recency bias gives us a feeling that 24% to is my birthright. Small cap has never done that.
So Maniji, let's do the whole exercise. So this is, if you can see my screen, this is the BSE small cap index. I have data starting from 2005. Okay. The CAGR for this since the beginning is 13%. Let's first get that out of the picture. Small cap index.
1-3.
Yeah.
You have to be, yeah.
Small cap index, the return for the past 20 odd years is 13%. Okay. Now, to get that 13% CAGR, what all do we have to go through? This is 2008. Okay. Starting from here till here, this is what drawdown 80%. Okay. The whole index fell 80%. I'm pretty sure some of the stocks had fallen more than 80. Okay. Next one, from here till here, which was a very bad, difficult, flat market, the drawdown was 54%. From here to here, this is 18 till start of the probably the end of COVID downfall. This is a drawdown of 58%. Let's not go too far. This is starting from December 24 till this year starting. This is 30, almost 30%. Now, to get that 13% over time on a small cap index, we have to go through these phases. Okay. This is just in the past. I mean, this is real data, past data that we are seeing in front of our screens. Now, how are we going to say that when I combine something? Now, sorry, one more point. Whenever you see a time period when it has gone up, and in the past 5 years it has given you a decent return, something or the other happens in the world, and the mean reversion will happen to the index. That's the way the universe works. That's the way the stocks works. That's the way the stock market works. That's the way geopolitics works. Nothing can go straight up in a straight line. Okay. If some fund has given a return of 25% for the past 5 years, very, very, very high chances that the next 5 years, the return will not be as much. It will mean revert. There's a reason why. 25 years growth so 25% growth for a continued period of time is mathematically impossible. The best of the best people have done, say, late teens, 19, 20. Warren Buffett's own portfolio is around 19 now, and he himself says that it will come down. Something like even PPFAS has started admitting today that their returns will not be as good as they have been in the past. There's a mathematical reason. You cannot keep buying stuff and expect that it will keep going up, because there's only so much money in the world, right? Now, this is just the small cap index. Now, to your point that if we combine this with one large cap, one mid cap, one small cap. So in that case, what we have is basically Nifty 500. Okay. Now, if you see, the chart will be very similar there also. Same kinds of drawdown happen. The return is 13.75% since we have the data since 1999. Same kinds of drawdowns will happen there. If I just calculate this, this will be somewhere around 67%. This will be somewhere around 40%. This is COVID. Similarly, if you go back to the 2000 tech crash, this will be somewhere around 70%. Now, all we are trying to say is this is Nifty 500, the most diversified index out there. That index itself fell 70% during the dot-com crash, another 70% during the 2008 crash, another 40% during Corona, again 20-30% here. If we are going to go and have a product which gives us 70% drawdown and give us 13% over time, why not try to achieve that 13% in a better ride? I mean, a smoother ride. That is the point we are trying to make from our factor portfolio, that maybe instead of falling 70-80%, we try to fall 35-40% and still try to achieve these kind of returns.
Yeah, clear.
I know it sounds very ridiculous, but that is the whole idea, that if we are able to combine two uncorrelated asset classes, say something like a debt or a gold or some other asset class that we can figure out, maybe we can smoothen the ride. And I'll venture out and say, if we even reduce the return, say instead of the 13%, we get 11 or 10. Still it's a better result, because first you have to get that return in your wallet. Otherwise what will happen is, जब वो 60-70% गिरेगा, सब लोग कहेंगे यार मैं तो निकल रहा हूँ, ये मेरे लिए नहीं है, I don't like the kind of drawdowns I'm getting. So we want to hit on that drawdown number first. Returns will take care of themselves.
Also, this is a very valid point, Manish ji, because this hits the psychological chord. Everybody needs this mental shift. I mean, do this exercise yourself. Make a list of unique portfolio stocks that you have, and you will be in for a surprise. You'll realize that जितनी मर्जी एक्टिव आपने गेम खेल ली, you are practically an index investor only. आपने 500 से ज्यादा स्टॉक खरीदे हुए हैं अपने स्टॉक में.
Yeah, that's true.
But Manish, we might be holding say 300-400 stocks, but the proportion will differ, no? So that difference in proportion can make a lot of difference, no?
We've done this exercise, Yogesh. Proportion भी same रहता है. जब आपने 500 स्टॉक ले लिए थोड़े, ऐसा नहीं है कि आपने किसी एक स्टॉक में 10% डाल दिया है. आपने सब में छोटा ही डाला है. You are practically bought a Nifty 500.
वो proportion भी same रहता है, योगेश. मैंने बहुत टेस्ट करके देख लिया, वो हो भी नहीं सकता. आप ये सोचो ना, वो कोई भी फंड मैनेजर अगर उसके पास 1 लाख करोड़ रुपए, he has 1 lakh crore to invest. What can he buy from that 1 lakh crore? How much? He will have to
tell me any mutual fund which is taking concentrated bets, yaar.
They can't. It's mathematically impossible to take, because once you grow big, every mutual fund wants to grow big, right? Once they grow big, they cannot do anything that is different from the market. So one has to be careful that, okay, what am I trying to achieve? Am I trying to achieve the highest return, or am I trying to achieve a decent return which lets me sleep at night? And one more point. How many people do you know who have that 25% return over a 25 period return in their portfolio. You will find almost, I mean, next to zero people who have that on a big corpus. Very, very difficult to do.
Yeah. Show me that investor and I'll make you meet Harry Potter.
Yes, so that is the main point, right? Why are we trying to achieve 25% CAGR, which so many people who have done it, and why not go for a lower number and make it realistic that okay, my portfolio generated 13% over a 25-30 year period. I mean, people should realize that that itself will give you a huge amount of return in terms of absolute numbers.
And since Inflow has chosen this momentum factor fund, so in a rising market, the universe of that factor fund is Nifty 500, right? It's a Nifty 500 top 50 momentum stocks. So in a rising market, whenever the small caps and mid caps are firing, it's fair to assume that uh, uh, sort of higher return will get captured through the momentum fund itself. We
No.
need not pick small caps and mid caps separately. Whatever excess returns they are generating in a rising market get reflected in the momentum fund. Is it a fair assumption?
No. So there will be times when your small cap and mid cap are doing far better than what the factor portfolio will do. But as I
No,
said,
I'm just talking. I'm not saying about the entire factor portfolio. I'm just talking about the momentum fund itself. That
Even in that, Varanya's point is valid. There can be time when the small cap is catapulting faster than your momentum factor, and for that we have the sector calls as well. So maybe when small cap is firing, our algorithm will pick up the small cap index as well.
yeah, see, एक आदमी है, he is trying to make rockets and go to Mars. एक आदमी है जो अपने गल्ले पे बैठ के रेवड़ी बेच रहा है, ठीक है? Whose business is more stable, right? Obviously, someone who's trying to achieve something like going to Mars is going to have a high failure rate, right? But obviously, when he wins big. We are not in the game of going to the stars here. We are in the game of generating meaningful returns on a decent amount of corpus where people see most people who are going through mutual funds it's not their full-time job, right? They have some other source of income coming in. They have their own businesses, they have their own salaries. This is on the side for most people. If you are a full-time investor, I'm not recommending factor portfolio to you, right? This is for people who want to have a smooth equity, right? Which is giving them a lesser, a better chance of being at it for a long period of time.
I will to go ahead and say, even for full-time investor, run this as a sidekick, and you'll realize that this is beating your regular gig.
Yeah, I agree actually. So I have started my wife's portfolio on this factor thing now because I don't want to look at it. I'm like, okay, I'll look at it after 20 years. Let's see what happens.
So, Manish and Varun, I have like two questions.
Yes, please.
One is related to when we are looking at momentum, right? So previously, when Mystic Wealth was running, our rebalance frequency was weekly. Now, when we switch over to these funds, I think their inherent rebalance happens every 6 months, right? Based on the index.
Yes.
So, is there any trade-off being happening there in terms of returns? So that's one question. I can pause, or shall I go for my second question also?
No. Let's go one by one. Manish, do you want to answer that?
Yes, definitely there'll be a ding, Dinesh. This is a mutual fund offering and not a direct equity offering. Our MWM was hitting 30% CAGR, and then it started coming down and came down to 25% CAGR. यहाँ पर you will not get that return. यहाँ पे we are aiming for a consistent, let's just say, I don't want to quote figures because again outside the ambit, but expect a reasonable 16 to 18% returns here, or maybe lesser. So there's definitely a gap of around 10% CAGR between active momentum investing and mutual fund thing. Yeah.
So one more point.
There's a tax benefit here.
Yes. So one point that I wanted to add was on a weekly rebalance, your post-tax returns might be similar to what the index will give. Just think of it in the sense, India has this rule which is pretty good, that at a fund level, whatever rebalances they do, it's not.
Yeah. Right.
So why not take advantage of that? If you are going to stay invested in a fund for a long period of time, the tax benefit itself can catapult your portfolio by a few percentage points. So that itself, I think, is a very big point.
Yeah, around 2-3% CAGR का फर्क पड़ता है टैक्स से ही.
ज़्यादा भी पड़ सकता है. If you look at times when the market is very haywire, going up and down, the rebalances can be higher. So
yeah, total मिला के बता रहा था. Yeah.
So over time, see, over a big period of time, 2-3% is a huge number. So
Yeah.
you have to keep that in mind.
Plus, also remember another huge benefit in MWM, you were really active. यहाँ पर आपको you basically are sleeping at night. You're not really bothered about the portfolio. You're just doing SIPs, whereas we were very active in active momentum.
Yeah. So second questions. So second of the three questions. Second question was when we are doing this 30-70 proportion, and we actually said that the 30% dry powder will be deployed on certain drawdowns. So is it like staggered? Like is this 30% spread across like multiple levels of drawdowns, or is it just one drawdown, or is it something? I mean, how is that going to be happening?
Yes, staggered by 2, and even that would get an exit if the call was wrong. So yeah, it's staggered into 2 components, like 50-50.
Okay. And third question was basic question, more in terms of how do we operationalize, like assuming that you will ask us to do a SIP of one momentum, one factor fund, and one, let's say, debt fund. So how do we rebalance? How do we ensure that the proportions stay in line with what, I mean, more operationally I'm asking?
Yes. So I'll answer that. Dinesh, this rebalance is not going to happen too often. Okay, one is that. As you can see in the chart, if we just stay put with 30%, the returns are not that bad. This is for extreme shifts in the market. Say something like last year, when in September things were looking very good, everything was hunky dory. Maybe at that point of time it made sense to reduce equity. Say something like COVID, when things look very bad, it makes sense to increase the equity component. Something like, say, maybe 2021, 22, when the markets had taken a pause. Now, there is no mathematical way of saying that, okay, this is the exact date that we will enter. You try, if you be in the markets for a long time, you will get a sense that, okay, things are looking pretty bad or things are looking pretty good. And we can also see that on our own returns, that we have done pretty well for the past 2 years, and then we'll start taking those calls. Like Yogesh asked earlier, if we can make that back test. One of the reasons why I don't do it is because in a back test it will be far easier to do. Going ahead, it might not be that easy to do, but at extremes we can take that call very well.
This question, Varane, is around logistics. How will you?
Yeah, I'm coming to that point. So we won't have to rebalance very often. Now, say you have started a SIP and say for the next 2-3 years it keeps going and there is no rebalance happening and a decent corpus has been accumulated. So when that rebalance happens, we can just sell the part of the debt and reallocate it to equity and vice versa.
Yeah,
so that will be a single transaction. We'll initiate.
Yeah. So that will be at our end. We just do it manually, right? On an Excel sheet, right?
You'll get an email. Yes.
Send an email. We'll initiate the orders from our own side. You just have to approve those orders.
Right. Got it.
Great.
Yeah, and I don't know if again, this is, if no one else has any other questions, maybe something about the PMS that's launched, I think, or is about to launch, right? Maybe some commentary on that.
Yeah, Manish, please.
PMS is up and running, Dinesh. We have launched both Mystic Wealth Momentum and Mystic Wealth Value as a PMS offering. You can also divide that investment into two, that 50 lakh requirement. You can divide in any proportion that you want between these two strategies. We are in the process of bringing in all our friends and family right now, and then we will, I mean, it's open to everyone right now as well, but our emphasis is right now just friends and family, and then we will pitch it to all our advisory clients as well.
Sure. Got it. Thank you.
Yeah, are there any other questions? Anyone, please feel free to ask whatever is on your mind.
Varanya, one suggestion, maybe in future calls we can take up this point that you were explaining, that in active funds, even though the an active fund might hold slightly different proportion of stocks, it does not differ meaningfully from index. Like if we can, is it possible to show it in a, or explain it in some?
I'll show it right now.
Okay, because I always had this.
This is a valid
Maybe
point for the next presentation as well, Varanya. While you can show it right now, but this can be a
No,
good
I've done
content.
exercise to some extent, so let's see if I can do something.
I always had this probably an erroneous assumption that if the proportion of funds is, or the stocks is different, but yeah, maybe
Varanya
meaningfully
has
it's more.
created this utility, Yogesh. I'll walk you through that utility. It's amazing. You put in the data and you see uh, the number of unique stocks that a portfolio has, and also allocation to each stock. And you will be shocked out of your wits of all the uh, iterations that we ran. Everyone has 400-500 stocks, and the allocation is what, same 1% or whatever.
So before I do this, just to hit upon the point once again, this exercise was for mutual fund portfolios which have more than 3-4 funds. Okay, but it's valid on one single one as well. So let's pick up the bigger ones, the HDFC Flexi Cap. Okay, this is the current portfolio as of October 31, 25. Look at what it is holding. ICICI Bank 9%, HDFC Bank 8%, Axis 7%, SBI 4%, SBI Life 4%. At this point, HCL 3%. Everything below that goes down to below 2%, 1%. And if you keep going down further, 0.1, 0.15, 0.3, 0.4, basically won't move the portfolio too much.
So basically, पहले 4 में ही 40% of the portfolio is in Nifty 50 only.
10 plus 10,
They
20.
basically clone the index itself. और बाकी सब में
30-40% portfolio is basically 4, 5, 7 large cap companies. Okay. If we include till here, it will be around say 40-50%. Now let's look at Nifty 50 or Nifty 500 composition. So this is a file that you can download. Okay, it's not giving me the percentage here. 1 second. Okay, look at this. This is Nifty 500. Okay, HDFC Bank 7%. HDFC Bank 8.5%. ICICI Bank 4%. ICICI Bank 9%. Reliance Industries 5%. Where is Reliance here? They are probably not bought Reliance here, but Bharti Airtel 2%. Bharti Airtel was here, right? 2.48%. So as I said, not much difference will be there. Now, why we can also talk about why this is the case. See, what is the AUM for HDFC FlexiCap? 91,000 crores. Okay. Now look at this. Let me create a screen. Let me sort it by market cap. Now, when you have 1 lakh crore to invest, how many companies can someone buy? You cannot buy the entire lands, right? You cannot buy the entire HDFC Bank. You cannot buy the entire Bharti. So there are only so many companies which you can buy, right? And because it is flexi cap, you cannot buy all micro cap, small cap companies. So there's a mathematical reason why this happens. Because once you have grown too big, what else will you buy? I hope that answers the question, Yogesh.
Yeah. Is there a tool or something which gives a sort of intersection between the fund and Nifty 50 and 500? Is there some
Rule.
tool on
Yes.
some?
Yes, I think there's some ratio. It's called something. Sahil Kapoor tweeted on this topic.
Okay.
क्या बोलते हैं उस ratio को यार? I mean, it's a pretty common thing in mutual fund world. Every fund manager knows it. That ratio basically tells you how much you are deviating from the index, or are you a closet indexer or not.
Okay.
Yeah. If there are no other questions, anyone else? I think that's pretty much it.
This was fun, guys. Thank you for taking out time out of your Saturday. Hope we'll do it again as well. But this was nice. Thanks for coming.
So yeah, thank you all for joining. We hope that you guys got something out of this meeting. We are a new company. We are trying to grow. So if you like what we are doing, if you like our work, please spread the word around. Please become our clients if you feel that whatever we are trying to say is making sense to you. We have our website. We keep sharing our details. We keep writing newsletters to you. If you want to get on the list, please get in touch with us. And yeah, that's pretty much it. Thank you again for joining. We have recorded this session, so we'll try to upload it at some point. If you missed out on this on some part, you can maybe go through.
Send out those material that you already made, right? You mentioned.
Will do. Yes, Dinesh.
Thank you.
Thank you. Bye.
Bye.
Thank you. Bye-bye.
Bye.